Yo, how's it going?
Yo.
How's it going, man?
What's going on, brother?
What's
How you
up?
doing?
Pretty good. How are you?
I'm good, man. I'm good. I'm just trying to get some knowledge, you know what I'm saying?
Yes, sir.
There's some more guys join here. Yeah, there we go.
Yeah, I'm not going to start for like 5 minutes because people are usually late, so.
That's cool. Yeah.
Good, sounds good.
What's up, John Trez?
Not much.
Can barely hear you, man.
Maybe turn me up on Discord. I mean, my mic's all the way up, so I don't know.
Oh, yeah. No, I can hear you better now.
Alright. Wait, so you guys are all new to this too? Or just starting, or what's going on?
Well, I'm the one that's doing the presentation, but I've been trading for about 2-3 years now.
Alright.
Yeah, I'm trying to get into it myself, you know, over the course of maybe like the past 2 years. I've been seeing a lot of people, you know, just like start out with, you know, $500 and, you know, over the course of time, you know, it can turn into 10,000, you know what I'm saying?
Yeah,
like
of
I'm
course.
just trying to like find out like the best course of action.
Yeah.
Yeah, so basically what we're going to talk about today is just the very basics, you know. We're going to run through literally the extreme basics, what you need to know if you didn't know anything about day trading. So if there is anyone that, you know, already has some prior knowledge, it will be a little boring at first. But then at the very end, I can walk you guys through getting, you know, on a Robinhood account or a Webull account, and on a paper trade or Thinkorswim, anything you guys want to trade, I can walk you through getting an account on there. And then you can go ahead and start paper trading with us in the Discord.
Okay, cool, man.
And then, yeah, in this Discord, we don't do any plays or any call-outs or anything. If you guys want that in the future, I can hire some guys to do that. I know some guys who've been trading for years, work for, you know, hedge funds, and are intern at hedge funds over summers, you know. So we could definitely get it popping right there. But if not, I could definitely refer you guys to some really good traders that do have Discords that, you know, you have to pay to join, but are definitely worth it.
Yeah, and just to touch on that real quick too, I mean, I've always heard that it's best to invest in yourself and, you know, maybe invest in like a course or something like that, man. But, you know, I've just always been so skeptical, especially with, you know, being online, you know, like I just don't want to get like, I don't want to pay for something and then end up getting like scammed or some shit, you know what I'm saying?
Oh yeah, for sure. It's definitely a scary place out here. But yeah, that's why I can definitely refer you to some guys, you know. A few guys I can think of right now. 2 guys, I'm in actually, you know, this guy named 1K. He posts his trades every morning. He also does education in his Discord. Same with TJR. And that's really what you want to look for. You don't want to look for a guy who just posts his call outs, because you can find that on Twitter and be profitable, right? You want to find someone who's also going to teach you his strategy and walk you through why he takes his trades every day.
Okay, I feel that.
But all right, I'm going to go ahead and get started right about now. And if you guys have any questions, you can just blurt them right out, all right? Don't feel bad for interrupting.
right, sounds good, man.
All right, so day trading, right? That's why we're all here. So the intro to, are you guys all on the stream or no?
Yeah, I'm watching.
I'm watching it, yeah.
Okay, just making sure. So day trading, right? That's all why we're all here. The intro to day trading and what is paper trading. By the end of this, you should have a very basic understanding of day trading and paper trading. Securities. This is what we're going to be trading, right? The term security is defined broadly and to include a wide array of investments such as stocks, bonds, notes, debentures, limited partnership interests, oil and gas interests, and investment contracts. Each trader usually is specialized in one or a few different types of securities. In this case, I trade stocks, shares of a company, right? So what are stocks? We trade stocks, but what are they? So the very real definition of a stock is a stock, also known as equity, is a security that represents the ownership of a fraction of the issuing corporation. Units of stock are called shares, which entitles the owner to a proportion of the corporation's assets and profits equal to how much they own. Think of stock as a pizza. This is my basic definition for anyone who doesn't know. This is what I tell my friends, right? So think of a stock as a pizza that you can see on the right. So in this case, this pizza has 6 slices. Say I own the pizza, right? And I'm selling each slice for $1. The more that people buy up my pizza, so say it gets up to where 5 of my pieces are bought, that last one is going to be worth a little more, correct? So I would go on to sell it for $2, which makes the rest of the pizzas worth $2, right? So now all the pizzas are worth a little bit more. So the slices of pizza you can think of as stocks of a company, right? It's obviously not 6 slices, but it's on millions and millions and millions of shares of a company. So, companies such as Tesla, Apple, Microsoft, and Google all have their own pizza or stock, right? So how do we trade these stocks, right? So any business, you have to buy low and sell high to make money. When day trading stocks, the whole point of trading is to make money. And the only way to make money is to sell a stock for more than you bought it for. When doing this, a stock only fluctuates at, maybe $1 or $2, very rarely at $10 on the daily, right? So the most you can make on a stock would typically be, anywhere from a couple cents to $10 per day. This is because you can't trade with leverage when you're just buying and selling regular stocks. You can mainly, like this right here says, basically, trading without leverage, you can realistically yield 0.5% to 2% a trade. So how are we supposed to take $500 to $10,000, in within a month or even within a year, right? So this is why you have to leverage your money and be able to trade money or trade your stocks not only when the price goes up, but when the price goes down. And this is how you're going to make bigger daily gains. Keep in mind that if you do have a higher reward, that's going to mean you're going to have higher risk, right? And when it comes to that, that's why we start with paper trading, so you don't have to risk your own money, because I can guarantee anyone who starts without a basic knowledge or without a very good understanding of how options work, they are going to lose 100% of their money. So only trade, if you are going to go that route, only trade what you're willing to throw away. Think about it as burning money. Think of it as that. So how do you leverage your money, right? We're talking about leveraging your money and not making only 0.5% to 2% on your trades. The way to leverage your money is to trade options, is what I just said, right? Option contracts is where you buy and sell 100 stocks at a time without actually owning them. You're able to leverage your money because you're trading on a 100x basis without needing all of the money, right? So imagine, instead of only buying 1 pizza at a time, you can buy 100 pizzas at a time for the price of, say, 6 or 10 pizzas. It's called an option contract because you have the option, no obligation, you have the option to exercise it, but you don't have to, right? So it's called an option contract because you have the option, not obligation, to exercise the contract or let it expire. If you decide to exercise the contract, you will buy 100 shares of whichever stock you are trading. If not, the contract will just expire and be worthless. Of course, if it expires and becomes worthless, then you lose 100% of your money. Your contract will go to $0. And we don't want to see a contract that costs, say, $100 go to $0, right? That's 100% loss. So the way that you make money is you buy it, say, expiring a week out or 2 weeks out at a price. Once the price moves in the right direction, you sell it for a little bit more. It's small profits make a profitable trader. So these contracts are called calls and puts, or longs and shorts. If you think that the price of the stock will go up, you're going to call it a long or a call, right? If you think that the price of the stock will go down, you're going to call it a put or a short, okay? And you can either buy a contract in the money or out of the money. So this is what a contract, the contract chain looks, or an option chain looks. This is how it looks. The Webull, it does look very confusing for the naked eye that doesn't know anything about trading yet. Robinhood is a little bit more user-friendly. So as you can see for calls in the middle, Robinhood calls, where the arrow's pointing is in the money, because when you buy a call, you're gonna bet that the stock is gonna go up, okay? So anything under that stock is gonna be in the money because it has already passed that. If it is out of the money, it hasn't gotten there yet, so it has not reached the money. It's the opposite for puts, right? If the price of say the price of the share of SPY is 376 and it continues to go down to 375 or 374, it'll go into the money, but that is out of the money right now because it's not there yet. Where the price 377 and 378 and 379 is already in the money because it has already passed that stock price.
Hey Jay.
Yes.
I just got a quick question. At what point when you're positive do you would you start to take some profits or?
Yeah, so I mean it just depends. If there's no reason to sell, you shouldn't sell unless, you know, if you sell too early or you sell too late, it's going to be based off emotions and not your technical analysis. I'm going to go over some deeper technical analysis on like when to sell, when to buy and stuff like that in another presentation, maybe next weekend or sometime throughout the week, you know, or I'll post a YouTube video on it, okay? But yeah, we'll get deeper into that. This is just for the very basic trades.
Yes, sir.
If my surroundings get a little too loud, just let me know. I can move for you guys.
Okay.
So what is the best brokerage to trade on? Because right there we had three, right? Oh, I skipped too many. So we have 3 brokerages right now, but we're gonna go to that in a second. So first we're gonna do price spread. A stock spread is the difference between its bid and ask prices. So someone who's bidding on it is trying to buy it, and someone who's asking on it is trying to sell it, okay? Say a stock has a bid price of $10, people are trying to buy it at $10, and an ask price of $10.05. People are trying to sell it at $10.05 per share. In that case, the spread would be 5 cents. The spread goes to the market maker who is responsible for pairing buy and sell orders in the stock market. So your market maker is, say, your institution or your brokerage that you're sending your order to buy it. So they're either going to say, okay, well, we're not going to be able to get an order at $10, so you're going to have to buy it at $10.05. Where in a few seconds, maybe the price goes down and you could actually buy it for $9.95. What is a brokerage, right? So we just talked about you'll send your orders to your hedge fund or your brokerage or your institution, right? Securities account, sometimes known as a brokerage account, is an account that holds financial assets such as securities on behalf of an investor with a bank, broker, or custodian. Investors or traders typically have a securities account with the broker or bank they use to buy and sell securities. So you used to be able to buy it over the phone or in the newspaper or whatever. Now it's strictly online, right? So you have to go through Webull, you have to go through Thinkorswim, or you have to go through Robinhood, you have to go through TD Ameritrade, you know, one of these big brokerages. What is the best brokerage account to trade on, right? There's so many out there. It's really personal preference. When you ask someone if they think that the Ford or the Chevy is better, they'll say, oh, I think Ford's better. And this guy will say, oh, no, Chevy's better. There's no right or wrong answer, right? The only right or wrong answer comes to regulated or unregulated. If you're going to trade on an unregulated brokerage, fine, go ahead and do that. You know, oftentimes they'll offer awesome benefits, but if they do end up going bankrupt or going under, you know, their business model didn't work and they become non-existent, you will lose all of your money. If your brokerage is regulated, you will be FDIC insured on some of that money, so you will be able to either have stock in that company, which won't really be worth anything since they are bankrupt, or you will be entitled to, you know, a little bit of your money. And then at the bottom right there, you know, you can go to the SEC's Investment Advisor Public Disclosure IAPD website to check. Price action. Price action is the movement of a security's price plotted over time. Price action forms the basis for all technical analysis of a stock, commodity, or other asset charts. This is talking about stocks, crypto, forex, futures, all of those things, which I mean, some of you guys probably don't know what a few of those are, but crypto and stocks are pretty well known. So I mean, the stocks, the technical analysis will go for anything, right? And that's how price action is what moves the stocks. So many short-term traders rely exclusively on price action and the formations and trends extrapolated from it to make trading decisions. Price action is using the current and historical behavior of the stock to determine what its next moves are likely to be. This is a very vague explanation, and I'm going to post some videos in the Discord and explain more on another presentation on another day. But this is a very basic understanding, So any questions on anything that was just said?
Nope, I'm good.
Everyone good?
Wait, I don't understand. How do you make money on a put? Like if
So
it's going down.
So right here, when you think the price of a stock is going to go down, you will buy a put, right? So right here you can see the calls and the puts. So do you see on the put side, or on the call side, all right? We see the call side, right? The numbers are getting smaller as you go up, correct?
Yeah.
So it's 360,
Okay,
293, 235. So say you buy that one for 293, and say the price of SPY goes up to 378. That 293 contract will start looking like more like 360, so $70 plus, right? So on the opposite side, you can see on the put side, as the price goes higher, that costs more, right? So the opposite. So the more in the money that the contracts are, you see 373, 308, 250. As the price of SPY goes down, say it goes down to 375, your 308 contract's gonna look more like 373, so a $70 gain again. And this is because, so this is how shorts or puts work. You basically say, hey, Robinhood, I wanna buy 10,000 stocks, so let me make it simple, 100 stocks of SPY, and then I'm gonna return them to you on a later day, okay? So they say, okay, we'll give you 100 stocks, right? So you get 100 stocks for them, and then when it comes time to pay them back, the stock price has moved down. So now you can collect whatever was in the middle. So say they lent you $10,000, and now the stocks are only worth $9,000. You only have to pay them back $9,000, so you would make the $1,000 difference. Does that make sense?
Yeah.
All right. Any other questions?
So
All right.
You get to keep that. So okay.
Yeah, go ahead.
I'm just trying to. Yeah. So I'm just trying to. So you're basically borrowing stock then, is what it is.
Exactly.